In one of my first proper jobs, my boss said, "Joe, always figure out what motivates people." And that's the approach we took to write this piece back in July of 2020 titled "How SPACs Reward Everyone Except Retail Investors." We took a lot of flack for that. Turns out that we were spot on. So today we're going to discuss three topics. The first is the dismal performance of SPACs as an asset class. The second is Palantir's inability to pick winning SPACs. And then, more importantly, we're going to look at whether there's some value to be had in what's left. So we're going to do a review of 21 disruptive tech SPACs. So we said SPACs were shite for retail investors from day one. We covered, nonetheless, 110 of them because there was such strong interest from retail investors. Of that population, we liked just 2, so about less than 2%. Like means that we'd consider investing in them. We invested in 1. We say love. We loved 1. So less than 1%, and we avoided over 97% of those names. Now, predicting the failure of these SPACs was common sense. If you look at what motivated stakeholders, sponsors, they made the easiest money of their lives. Startups, they found the easiest way to go public ever and raise easy money at very lofty valuations. And guess who footed the bill? Well, retail bag holders. So let's take a look at Palantir's SPACs. And if you recall, Palantir had invested in quite a few SPACs back in the day. And if we look at that portfolio, they took an 87% loss on it. Now, the deal is that we don't know the specifics of when they exited all these positions and how much revenue they were able to recover. So the arrangement was that they would give these SPACs money, and then the SPACs would give them equity and turn around and give them the money back in the form of revenues, right? So we call those related party revenues in any other case. But if we look at Palantir's track record here on being able to pick the best SPACs out there, they failed horribly. So 30% of the names that they had these arrangements with are now bankrupt. That means they're not going to be paying Palantir any revenues. There was only 1 out of all the SPACs that they invested in that actually had a positive return of 13%, and that's Ramaswamy's Roivant. What this shows us is that Palantir isn't very good at stock picking. Now, the plan was different. So they were going to identify the most promising disruptive tech companies, get them using Palantir software, take equity in these companies that would undoubtedly benefit from Palantir software, and everyone would win. Well, that didn't pan out. You see this article from, I believe this is Forbes. It says, this is back in November of 2021. Palantir has pumped over $400 million into SPACs and boosted its revenues at the same time. Well, related party. It's a throwback to the dot-com era, and Wall Street is worried. Well, yes, indeed. Competent management teams don't become lax during times of excess, and that seems to be what Palantir did. So hopefully some heads rolled over there over those bad decisions. Now, of course, that's all behind them now, but here's how we saw it. So the Palantir arrangements looked more like related party revenues, and there wasn't a vetting process in place there to ensure that the valuations that they were purchasing shares at were reasonable. Why didn't they pick up on this? Palantir had no business, this is the most important point, deciding which SPACs would outperform. That's not what shareholders want them to do. Shareholders want them to take their technology platform and sell it as fast as possible and capture as much market share as possible, not try to figure out which SPACs are going to outperform. Now, some money, of course, was recovered in revenues, but it's not likely much if these companies aren't thriving. Now, let's talk about our SPAC coverage. So we covered 110 disruptive tech SPACs. You can see the names here on the right across different tech themes. Of those, 8 had their mergers terminated. So we stopped covering SPACs prior to the mergers completing because this was happening. That's the tail end of the SPAC craze. 7 went bankrupt so far. So look at out of our population, the percentage that went bankrupt, and then benchmark that against Palantir's horrible track record of selecting SPACs. 6 were acquired. 3 by other SPACs and 3 by proper companies such as Shell, SoftBank, and EQT, a private equity firm. Now, I didn't run the numbers, but I would bet that all those acquisitions happened at a significant loss. That would leave 89 SPACs left. So let's take a look at those. These, by the way, are in our Tech Stock Catalog, which has over 460 tech stocks. It's an Excel spreadsheet that our premium subscribers can download, and I think there's upwards of 25 data fields in there that you can filter on. One of them is a flag titled SPAC, so just filter on that and you can quickly start to run some numbers. We did that. So of these 89 SPACs, 20 have lost more than 90% of their value, so that's 22%. 49 of them have lost more than 75% of their value. Over half of these have just decimated shareholders, and 72 or 81% of these have lost more than half of their value. So if we look at that population that's left, the 89 SPACs, just 7 of these names are trading for more than their debut price. Retail investors had their asses handed to them, and that shouldn't come as a surprise. But the question to ask here is there any value left to be had or just value traps? We asked those questions. Here you can see in 2 pieces. These were from 2022. One titled, Now That SPACs Have Fallen, Are Any Worth Picking Up? And the other titled, Avoiding Value Traps and Beaten Down SPACs. Now, we partnered with a data firm, and the name escapes me, so they provide data about funding rounds, and then we produced these tables, which are very interesting. This was based on an institutional investor who was a premium subscriber that wanted us to look at this. We thought it was a very good idea. What we did is we took a number of SPACs. I've only listed some here, and we looked at the last funding round from institutional investors and whether or not there was a discount based on today's market caps, or the market caps here, of course, are from 2022. They've likely fallen since then. But whether there was a discount or a premium, and you can see the table on the left shows a discount. So this would mean that, for example, Velodyne had their last round, a Series B, evaluation of $1.78 billion. And the market cap now is $436 million, so you're getting a discount of 76%. Then you can look at the opposite, right? Premium to the last round. So we did that exercise, and it was rather interesting. But today what we're going to do is screen these remaining names, and we're going to look at 21 SPACs very quickly, so hold on to your seat. Valuations should be more accurate now. Of course, there's some exceptions like hyped names such as IONQ, but for the remaining names, we want to see reasonable size, we want to see revenues, the existence of them, ideally they're growing, and positive gross margins. If you don't have positive gross margins, you don't have a business. And what we're going to do is filter on market cap. So we want to look at larger names, and we're going to filter from $750 million to $1 billion. That's what we've done here. We have 5 names. These names are taken from our catalog along with the notes field that exists for every single one of the 460 companies in that catalog. But just some quick comments. So Matterport has flatlined revenue growth over the past 3 quarters. We've written numerous pieces on this company and all the companies that we're talking about today, for the most part. Electric vehicle charging companies in that list, ChargePoint and EVGO, they haven't figured out the business model. We don't find that theme to be very compelling, and that's evident in their shite gross margins. The mess that's NKLA should be avoided like the plague, and that's because rotten apples spoil the bunch. There's unlikely to be a lot of value had in what's left over after their founder was convicted of fraud. Then you have Virgin Galactic. A lot of downside risk there and not so much upside benefits. We've written numerous pieces about why that is. Now, that leaves us with 18 SPACs that have a market cap of greater than $1 billion. So we'll start with 3 that have something in common. They're all eVTOL stocks. Our recent piece here in August of last year titled eVTOL Stocks Will Leave Retail Investors High and Dry. A bit clickbait there, but points really to this theme that we covered a year ago in 2022 titled, Can eVTOLs Be Cost Competitive with Cars? And that breaks down the economics. Until you start to see some traction in the form of revenues, that means they've cleared all the regulatory hurdles, these aren't worth taking a look at all. There's just too much risk there. So also not worth taking a look at would be these businesses in that list. QuantumScape. When you see a company that doesn't have revenues, you walk away. Until they have meaningful revenues, you say, well, next on the list here, you could see Aurora. Well, they have revenues. Yeah, that's $2.3 million. That's nothing. So, and you can see that was in 2022. We're looking at quarterly here, I believe. Yes, these are all quarterly. So until you see meaningful, we define that as more than $10 million per year. You just walk away. You're not interested. They haven't proven traction. Then you have a company like Luminar. Well, they had, $59 million in revenues over the past trailing 12 months. But look at their cost of revenue, $126 million. That's not a business. And look at how consistent that is over the past 4 quarters. They're selling something for less than it costs to produce, not a business. Then you've got ENVX there at the bottom. This is rather ridiculous. Look at the minuscule revenues, but also look at that cost of revenue. So they're going to really need to show some serious revenue growth in order just for revenues to start exceeding cost of revenue. These aren't businesses. We're not interested. Once they start to have meaningful revenues with a positive gross margin, ideally one that isn't razor thin, then we'll take a look. Brings us to the 3 EV stocks in the list: Polestar, Livewire, Lucid. Start at the top, Polestar. Look at, they've got some, well, first of all, we're looking at 2 things here. 1, we want to see a positive gross margin. 2, we want to see revenues growing. So if you read right to left, revenues aren't growing over the past 4 quarters, though they have generated over the past trailing 12 months over $2 billion in vehicle sales, which is great. So they're starting to prove their concept, but look at the cost of revenue. So razor thin margins. They're probably the most appealing of all EV SPACs out there. Then you have Livewire. This is a surprise that they're actually hanging in there, because we didn't think that electric motorcycles would get very far with riders. That maybe would merit another look down the road. And then at the bottom, you have some dreadful numbers there from Lucid. You can see sort of not increasing revenue growth, and the cost of revenue is ridiculously high compared to the revenues that they're bringing in. So these aren't stocks that we'd be interested in, though we may cover Polestar and Livewire more in the future. So let's talk about the most popular stocks on our list. Ginkgo Bioworks. We've written extensively on this firm, a lot, and published a lot of videos on them. There are concerns around the revenue growth slipping further into the future. Now, what you want to do is subscribe to this channel, because we're going to have a Ginkgo Bioworks update coming out soon, and these are very popular. Symbotic. It's the best performing of the 110 SPACs we talked about. It's the best performing one, somewhere 300% appreciation. Of course, you always need to compare that to a benchmark, but our recent piece, this was just months ago, looked at their heavy Walmart dependency and the news around their deal with SoftBank. That isn't what it appears to be on the tin, so you'll want to give that piece a read. Then we have AST Space Mobile. I've never seen more cheerleaders attack us in my life than around AST Space Mobile and the criticisms we've leveled at their sacred cow. SpaceX is what you want to watch here. They're showing progress for cell to satellite, that it's possible. That's very good. So we had speculated that would be the first thing that you needed to prove at scale, and SpaceX has done that. That's great news, but it's a double-edged sword, because it's bad news for AST. You don't want to be competing with SpaceX and all their resources when you're trying to launch a cell to satellite offering, and we would continue to avoid AST. More popular stocks in our list: SOFI. It comes down to this. We don't want any exposure to consumer credit, and here's why. The average APR right now is more than 20%. That's at an all-time high. Americans now owe over $1 trillion on their credit cards, an all-time high achieved in November of 2023, and delinquencies are rising. Very little upside, a lot of potential downside if things go wrong, as the American consumer always seems to hang themselves when you give them enough rope. Then we have IONQ, extremely overvalued. We've written about this numerous times, numerous articles and videos. And that brings us to Rocket Lab. It's one of a few space stocks we like. The cheerleaders finally went away. That means the valuation has become more reasonable. And of course, the cheerleaders are now starting to come back around, so you need to pay attention to that. But just set your simple valuation ratio target and wait, no FOMO. Then we have the last 2 businesses in our list. These are proper companies. You have Vera Mobility. Their bread and butter is collecting fees for tolls, parking, and traffic violations. But do you really want to invest in that stuff when you have vehicle autonomy on the horizon? We didn't think that was a good idea. Then you have CCC. We covered them rather recently. Title the piece, A Lesser Known Insurance Technology Stock. And it's really a solid SaaS business on offer with big plans to expand beyond U.S. auto insurance. So probably worth taking a look at. So just to sum things up, SPACs were an absolute disaster. Palantir isn't very good at stock picking, and there are still some SPAC names that, despite all the carnage, are worth taking a look at. So I'm going to go ahead and, for all the people that came around that are investors in Palantir, fans of the company, I've put up another piece here that you might find interesting on Palantir's politics problems. Give that a watch. Please make sure to subscribe to our channel. Thanks so much for taking the time to watch this today.